And let's begin our show by discussing what's happening on the global front and where we are headed. We're now joined by Michael Every, global strategist at Rabobank, on the show now. Michael, this has been a very tough market to call. There is still lack of clarity of how many more rate hikes, where the inflation is headed. You know, Korea has hiked rates by 6 times. They started their rate hiking cycle in August of last year, but it's done little to bring down inflation. And that seems to be the story all over. Fed has done 5 rate hikes. What's the call now in the markets? How would you assess the risk reward, and where do you think we're headed?
Well, to be blunt, what you're saying is absolutely relevant, but it was a lot more relevant a couple of weeks ago when that was where the market discussion was sitting. Right now, in light of the news that we got from the Bank of England overnight Asian time, markets are in a whole different space because the Bank of England, on top of the recent interventions that they've made to try and prop up bond markets and financial markets in general, on the back of the rate hikes that they've been pushing ahead with, have now come out and said, you've got 3 days to sort out all your imbalances and all your wonky trades and all your longs that should be short and shorts that should be long. And then we're stepping back from all market support. And from Monday, you're on your own. So you can expect some extreme volatility today, Thursday, Friday, and of course, going into next week, because either the UK has become an emerging market that doesn't know what it's doing, or rather the left hand doesn't know what the right hand is doing. And if it's going in that direction, everyone else will follow. Or they do know what they're doing, but what we're going to see is central banks continue to raise rates and not prop up financial markets at the same time, in which case all the volatility we've seen so far is just a warm-up.
All right. So what would the call be, Michael?
Well, so overnight, as I said, the Bank of England
Yes.
governor said you've got 3 days and we're not stepping in again. And we already have the Financial Times headline this morning that privately, apparently other people in the bank have told the Financial Times that don't worry, if there is volatility, we will step back in again. So which one is it? Are they stopping these market interventions to try and say, that's it, settle everything in 3 days and then you're on your own? Or are they going to continue to step in? The markets will, of course, test them, which means we will get volatility. And then we're going to find out whether or not the BOE and other central banks are prisoners of the pyramid scheme that markets have built on the back of low interest rates and too much liquidity from said central banks, or whether normality, what used to be normality, can ever reassert itself. So this is a wild, wild period with very, very high stakes poker being played by both sides.
All right. Hi, Michael. Good morning. I think wild describes it well. But, you know, as far as the U.S. is concerned, take us through what you're really penciling in for what could happen to the markets in the next couple of months. We did get the jobs data a few days ago. That looks very strong. It does not look like the Fed has any reason to sort of move away from this aggressive rate hike kind of, you know, the cycle that we're seeing. What do you think we could see in terms of a downside risk for the markets now? We had Jamie Dimon yesterday. He's saying another 20% on the S&P is a given.
Well, I don't make stock calls, but I have to say that particular one from Mr. Dimon sounds entirely reasonable. You know, he wasn't saying the same thing a year ago. What's lying in store for the Fed is very much what's lying in store for the Bank of England. I mean, the economy there is stronger. They don't have the same structural problems. They don't have the same degree of conflict, shall we say, between fiscal and monetary policy. But on a fundamental basis, you have a market which has been propped up by far too much liquidity and far too low interest rates for far too long. And you have a central bank which is also saying we're going to hike interest rates and keep doing it. The data have not turned anywhere near enough for them to stop doing that yet. And we're going to continue with QT, so drawing liquidity out of the market. And if that happens, you will see exactly the same crisis emerge that you're seeing emerge in the UK, where people who have gone leveraged long assets, which are now seeing the prices collapse because interest rates are rising, will start to fall over and collapse, and they will start to demand bailouts, because if I fail, they fail. If they fail, someone else fails. Then we have a systemic risk. And guess what? It's your job to stop that happening, which runs completely counter to what they're trying to do to fight inflation. So are we going to fight inflation, or are we going to bail out people who made really bad bets for far too long? That's basically what is about to be shown to the world one way or the other. And the implications for all of us couldn't be more important or larger, because if they go one way, inflation will come back and will remain in place. And if they go the other way, we will have low inflation, but we will have asset price deflation to match.
Michael, I should probably ask you what you make of Ben Bernanke winning the economics Nobel, but maybe we'll have that conversation offline. But what is the prudent move now for investors? Do you recommend that they should slowly start moving to cash? Because even if you move to cash, what do you do?
Well, cash has been the smart move for quite some time. And I will just slip in that Mr. Bernanke winning a Nobel Prize, someone else should have won one for comedy for that.
Well, Ray Dalio did say cash is not trash right now. But Michael, wanted to get your thoughts in on India and how does it stand versus the rest?
Well, in terms of the financial market dynamic that I'm describing, there is no hiding place, because if you get all the major economies acting like emerging markets, which is what we're seeing, with extreme volatility, then no matter how sensible or pragmatic an emerging market is, you will still be buffeted by that storm. And obviously, India is not immune to that. But if you ask me from my longer term perspective, as you see G7 economies start to look more like emerging markets, the larger emerging markets are relatively looking much more attractive. And I don't think that's a short-term trade, not one that I would recommend anyway. But in the longer run, I think India's standing continues to improve and India's stock continues to rise.
All right. Michael, just one question on the move that we've seen on the dollar. It's currently close to 113. Do you think we're pretty much close to a peak now, or do you think there's still some room?
Well, let's put it like this. If the Fed are going to keep hiking and you see other central banks blinking or failing to keep pace with that, then we are more likely to see that index you're referring to at 115 and then maybe 120. So we're talking about maybe a 5 or 6% increase from where we are now, carried across to all major FX crosses.
Michael, pleasure having you here with us on CNBC TV 18. Sounds like a bit of a tug of war. Let's wait and see what happens with Bank of England and what they finally decide. And even in terms of Fed, are they going to be going by the requirements of the market or the economic data? Get into a break on that note. On the other side, we'll come back and discuss what's buzzing in commodities. Manisha Gupta joins us next.